To Scott Black, president of Delphi Management. Scott, you know, I'm looking at my notes and you say people need to get back to work. When we get that Friday jobs report, are we going to see some improvement here, or is it still going to be pretty ugly in your view?
I'm not a short-term forecaster. I know that the numbers, we're down 6.1 million jobs year over year. We're down 7.1 million since the recession began. And the bottom line is the administration, with its stimulus, has to create jobs. They should have taken a page out of Roosevelt and perhaps not out of Lincoln. Now, I'm not an expert, but, you know, I'm not talking about make work, but there are plenty of infrastructure jobs. There are other things like support services and education, the hospital industry, medical, where there is demand, and they've got to promote job growth somehow. Handouts and transfer payments are very good in terms of defending people's standard of living, but that's not going to cause the rebound in the economy. Without a jobs recovery, this economy is going nowhere.
Hey, Scott, you're disappointed then by the infrastructure spending and the stimulus plan, but you do still like infrastructure stocks, right?
I do. We've been through this before, but we call a lot of the companies that we own, the little ones like Steel Industries, the medium ones like Commercial Metals, the big ones like Fluor, and nobody's seen a nickel of spending. And it's ridiculous. I know, you know, we passed the bill when Obama came into office at the beginning of the year. It's 10 months later, and some of this money should have trickled down to the state and local level to put people to work.
You know, it's interesting, Scott, because actually the president made some comments this week, and he said, okay, now it's time. We've got to really start thinking about the deficit. And he did also mention jobs. Do you feel like we're going to start to see something more constructive on those two fronts?
Well, he's put a lot of attention into health care and cap and trade, and I'm not saying that they're not important issues. They are. But the most important thing was to revivify the economy. We were on the abyss, and the bottom line is that people who don't have jobs aren't confident. If you look at a statistic called U6, which is the marginally employed, the people who have thrown in the towel, and those who are unemployed, we're at 17%. It's the highest number in the history of the United States since they kept score after World War II. That's 1 out of every 6 Americans is marginally employed, underemployed, or quit looking for a job. We cannot sustain the GDP of America without putting people to work in this country.
And nonetheless, you still like Aeropostale. That's one of your picks today. It's a retailer. It's a trendy retailer. Why, when you're concerned about the consumer, when you're concerned about employment, do you go with consumer discretionary stock like this?
No, that's a good question, because it's the old sell to the masses, eat with the classes. Unlike Abercrombie and Fitch at the high end, or American Eagle in the middle, they're at the low end, and they still have a popular base of 14 to 17-year-olds, and they've been comping at 11%. And they're growing the stores, about 40, 50 stores this year on a base of 900. There aren't too many companies that are growing 15% on top line, and the company's selling at 11 times next year's earnings, not a nickel of debt on the balance sheet, so you have no financial risk. The company earns in excess of 50% return on equity and 50% return on capital. I mean, it's a money machine selling an 11 PE. The average stock in the S&P now is selling something like 18 times earnings. This is a much better company than the average company in the S&P.
Scott, Aeropostale, certainly a little bit more of a household word, known to a lot of consumers and stock pickers. One that's not, though, the ticker is HOGS, Zhongpin. It's a Chinese company. Talk to me about this one. You like it. You always have interesting companies. Why this one?
Well, it's Chinese, similar to when I gave you Telstone the last trip. It's about a $14 stock. This year they'll do about $1.50, and the forecast earnings for next year about $1 billion in revenue, $1.85 in earnings. It's a 7 PE. The company earns in excess of 20% return on equity. They supply pork and pork products to about 3,100 retail outlets. 99% of the sales are indigenous to China, and pork is the largest protein source in China. And as you have a population that's moving upwards and moving from rice and vegetables to meat, they're going to benefit from this. So I don't think you go far wrong at a 7 PE.
Telestone, by the way, up 500% year to date.
Been a great call, really great call. Hey, Scott, great to have you back with us. Thank you so much.
Thank you for having me.
All right, take care. Scott Black, everybody.
We're going to take a quick break.
Us.